So we've calculated incremental unlevered earnings, but from the finance perspective, what we want to know is what the actual cash flow associated with the project is expected to be. And accounting profits are not actually really equal to actual cash flows. David Holland, the former treasurer and senior vice president of Cisco, has been quoted as saying, cash flow is a fact and earnings are an opinion. And what we need to do is get back to the facts, figure out what the cash flows associated with the project are actually expected to be. Why is cash important? Well, it's actual cash that's needed to support operations. Cash is used to fund new investments. Cash is used to pay interest or dividends. And so our investors care about cash, our workers care about cash. Everybody that has a stake in the organization really cares about the amount of cash that it has, and the same goes for new investment decisions. We need to know the impact that a new investment would have on the firm's cash. So the incremental effect of a project on the firm's cash is the project's incremental free cash flow, and so it's free cash flow that we want to focus on. So we'll convert from the earnings that we've calculated previously to free cash flow. And to do that, the first thing we're going to do is add back depreciation expenses each year. The bottom line is depreciation is not a cash expense. It looks on the income statement as if cash is going out. However, the cash actually goes out when we bought the asset that's being depreciated. So we add back the depreciation expenses that we have projected over time, and then we deduct the purchase of equipment. The purchase of equipment typically is expected to be incurred in year zero. The last thing that we'll do is deduct increases in net working capital. And so if you think of something like inventory might need to get built up right away. However, it doesn't show up in cost of goods sold until the unit is actually sold. So we need to deduct any increases in net working capital in order to properly show the impact that the project is having on cash. Last, we need to account for any other incremental cash flows, such as salvage values. So if we're able to sell equipment after the project is done, we'll need to incorporate that in the last year of the project as well. So we're going to start off with the incremental earnings, and remember this was unlevered earnings. Incremental unlevered earnings that we had calculated previously a few slides back. And the first thing that we want to do is go through adding back depreciation. So what we'll do is we'll take the depreciation and amortization expenses that were listed in the previous exercise. So there was a $0 depreciation expense. Then we had straight line depreciation, which gave us $1,500 in depreciation for years for all of years 1 through 5. We also want to subtract the purchase of equipment. and the equipment was a $7,500 purchase with cash going out right away. So once we have our incremental earnings, what we're doing, we're adding back depreciation and subtracting off any equipment purchases. For this project, there was no additional equipment purchase that was required over the project's lifetime. And so those are some of the adjustments that we're going to be making in order to convert earnings into actual cash flows. The next thing we need to do is incorporate any working capital requirements. And so net working capital is defined as current assets minus current liabilities. We can take our current assets as the company's cash, inventory, and receivables. The current liabilities that we're going to include are the company's payables. And so note that the company may have additional current liabilities, such as short-term debt or something along those lines. We're really only considering non-interest bearing current liabilities for the firm here. And so we're going to subtract off the firm's payables here. So any incremental free cash flow calculations have to account for any sort of change in net working capital. If we need to keep extra cash on hand to make sure our operation keeps running smoothly and that extra cash is due to this project specifically, we need to incorporate that. If we need to build up inventory right away, we need to account for that and not when it goes into our cost of goods sold. And so we need to incorporate all of these changes to reflect when cash flows actually happen. So inventories, receivables tie up cash. What's relevant for our free cash flow calculations is the change in net working capital. So if we have to increase cash or increase inventory at any particular time, that's what's going to matter. And so here we have changes in net working capital as being net working capital for whatever particular year we're looking at, year T. Subtract off the net working capital from the previous year, year T minus 1. So note that working capital requirements are often incurred when the project begins. That'll give us a year zero cash flow that is not incorporated in our analysis unless we actually put these working capital requirements in place.